In this video, we will explore about risks in investments. Specifically, we are going to understand three big words: volatility, uncertainty, and return. Let us start by comparing two different words to understand the trade-off between risk and return. On one side, we have a bank fixed deposit. This is considered low risk because the line on the graph is smooth and steady. You are unlikely to face a default on your interest or capital. On the other side, we have equity products. Look at the jagged line moving up and down. That is volatility. The dividends are uncertain and the value fluctuates wildly. The key insight you must remember is this: a high return can be earned only if the investor is willing to take higher risk. If you want safety, you usually have to accept lower returns. Now, let us talk about the silent killer of wealth, which is inflation risk. This is the erosion of value. It simply means your money buys less over time. We calculate this using a simple formula. Your return minus inflation equals the real rate of return. For example, if a bond pays you 8%, but inflation is 7%, your real return is only 1%. If inflation jumps to 9%, you actually have a negative real return because the inflation is higher than your coupon. Consider the case of Asha. She invests in a fixed deposit yielding 5,000 rupees per month. If inflation rises by 10%, her household provisions that used to cost 5,000 will now cost 5,500. Her purchasing power has declined, even though her income stayed the same. To understand how extreme this can get, let us look at the case study of Venezuela in the year 2018. Look at that red line shooting up. Inflation peaked at 65,370%. Prices increased roughly 654 times. The impact was devastating for bond investors as their investments became almost worthless. However, equity investors saw a different result. The Caracas Stock Exchange Index increased by over 1,000 times. This teaches us that equities can act as a partial hedge against inflation, while fixed income assets generally cannot. Next, we move to interest rate risk. Imagine a seesaw. On one side are interest rates and on the other are bond prices. They move in opposite directions. Let us look at scenario A. If the RBI cuts rates, new bonds might be issued at 7.5%. This makes your old bonds, which pay 8%, more valuable, so their price rises. Now look at scenario B. If the RBI hikes rates, new bonds might be issued at 9%. Your old 8% bonds are now less attractive, so their price falls. This risk does not just affect bonds, it hits equities too. Let us trace the four stages of this impact. In stage 1, interest rates increase, meaning the cost of borrowing goes up. In stage 2, this hits the corporate level. Companies borrow less, which means less expansion, leading to less profit growth. In stage 3, we look at valuation. A higher cost of capital means the present value of future cash flows is lower. Finally, in stage 4, we see the result. There is reduced demand for equity and the share price declines. Now we face business risk. This is measured as the volatility of a company's operating income. Think of this as the risk inherent in running a business. As you can see on the diagram, it comes from 5 main directions. There is commodity risk, like fluctuations in raw material costs; operations risk, such as employee attrition; competition risk from new products; currency risk if exchange rates change; and supply chain risk involving distribution issues. The most efficient way to handle this: holding a diversified portfolio is the key to managing this risk. Moving on to market risk. This is the risk of loss due to adverse price movements. we must distinguish between two types of assets. On the left, we have marketable securities like equity, bonds, gold, and real estate. These are subject to market risk because their prices fluctuate based on intrinsic value changes. On the right, we have non-marketable securities like bank deposits and small saving schemes. These have no market risk. They offer a predefined amount on maturity, but the trade-off is that they do not appreciate in value due to market factors. Then there is credit risk. This basically asks, does the borrower have the ability and intention to pay you back? There is one exception called the sovereign exception. Governments generally do not have default risk on local currency because they can simply tax or print more money. For everyone else, we use SEBI standards to rate them. Look at the ladder. AAA or A1 indicates the highest safety. As we go down from AA to BBB, the risk increases. At the bottom is D, which stands for default status. Remember, a lower rating means higher default risk, which usually forces the borrower to offer a higher interest rate. Liquidity risk is often overlooked. It essentially means you cannot convert your investment into cash quickly without losing value. This happens in three ways. First is company capacity, where a firm cannot meet short-term obligations. Second is asset nature. For instance, selling shares is easy, but selling real estate is hard. Third is market depth, meaning are there enough buyers? Look at the example of the sovereign gold bond maturing in December 2025. The gap between the buying price and selling price, known as the spread, is greater than 80 rupees. This means if you try to sell, you would have to sell below the intrinsic value because there are simply no buyers. Related to bonds, we have call risk. This is the possibility that a debt security will be called or redeemed prior to its maturity. Here is how it works in the timeline shown. You buy a bond issued at a high coupon. Later, interest rates in the market fall. The company decides to exit early to save money, so your bond is stamped CALD. The company then issues a new bond at a lower rate. You get your money back, but you lose that high interest rate you were enjoying. This leads directly into reinvestment risk. Imagine a cycle. You receive a coupon payment, but now interest rates in the market are low. So when you reinvest that money, you have to do so at a lower yield. This results in a lower total return over time. The rule is simple. If rates fall, risk increases. If rates rise, risk reduces. One way to protect yourself is by choosing the cumulative option, which automatically reinvests your interest, acting as a shield against this risk. We also have to look at the macro environment, starting with political risk. This is the risk associated with unfavorable government actions. It can take the form of nationalization, where the state takes over assets. It could be changes in tax structures affecting corporate or investment taxes, or it could be licensing changes affecting the permits required to operate. Almost all businesses are exposed to changes in laws. Expanding on that is country risk. These are risks emanating from the socio-economic and political factors of a specific country. As the map suggests, ripples from a single country can spread out. If a nation faces instability, it affects the performance of all securities in that country and can even impact its trade partners. This applies to every type of security issued in that region. Now, let us categorize all these risks into two main buckets: systematic and unsystematic risks. Systematic risk is undiversifiable. It is felt across all investment categories. These are caused by big factors like war, government policy, or recession. You cannot eliminate this through diversification. On the other hand, Unsystematic risk is diversifiable. It is specific to individual securities like a factory strike or poor management. The solution here is simple. This risk can be diversified away by adding other assets to your portfolio. Finally, let us look at some examples to bring this home. Meet Ajay. He invests in infrastructure shares. If the government changes budget allocations, he can handle this by investing in other sectors. However, if there is a recession or an interest rate hike, the cost of borrowing goes up market-wide. There is no diversification solution for that. Now look at Ashima with her bond portfolio. She faces credit default risk, which she can manage by buying highly rated bonds. But if there is an interest rate hike, the prices of all bonds decline. That is a systematic risk she has to accept.